35 points lower. It's neither here nor there. 16,940 or so is where the index is at. Vinit Sambre is head of equities, DSP Investment Managers. He's joining us now. Vinit has been advising caution for some time. Past few occasions we've had him on the show, and it's played out. Vinit, thanks for joining in. At 16,940, how do you assess risk reward? And I'm only using the Nifty as a gauge to assess the broader sort of sentiment out there. Have valuations come off quite a bit or still rich? What's your sense?
Good morning, Prashant, and thanks for having me on the show. You're right. I think definitely at the higher levels, there was some amount of caution which was required. And I think triggers could be anything, but events typically follow. And with the, with likely what is happening globally, higher inflation, higher interest rate, I mean, those are basically just maybe the reasons for whatever we are seeing right now. So I think clearly we are in a very uncertain environment at the moment, and at the same time, like you mentioned, there is a lot of uncertainty. There is going to be more, sentiment-driven volatility in the markets. But it is very important to keep an eye on the valuations from the market's perspective overall. And, when I actually look at the valuations and compare it to the 10-year averages, I think in the last couple of days, we have seen the 1-year forward basis, the market valuations have come marginally below the 10-year averages, which is maybe a good starting point, let's say, from the long-term investment perspective. So clearly, the markets are, in terms of the valuations itself, they have come down to, let's say, slightly reasonable level, maybe slightly more downside from here. They could be they may become even more attractive from the purely valuations perspective. So I think it's good to start looking at maybe nibbling some bit of investment at these levels from the valuations perspective.
Okay, by the way, a couple of stocks that do deserve mention. One of them is Dixon Technology. The management spoke to us a while back, and there was a change in their tone. For very long, they were talking about a slowdown in the mobile business. Now they are saying mobile business has picked up compared to what they saw in Q3, and they are hopeful of getting new customers on board very soon. So the stock is looking good. And the other one is Samvardhan Motherson. Surbi was also referring to that a while back. 9% lower now after that 4% equity block deal that happened. But a big gash seen on Samvardhan Motherson. Vinit, hi, good morning, and thanks for being with us on the channel. I wanted to talk about specific pockets, right, and what's happening there. I know there's no direct correlation of what's happening with the global banking turmoil and our own banking system, but do you see some pressure creep in? Because the banking names have actually seen a bit of an underperformance this year. PSU banks have also come off their highs. What do you do at a time like this with both private as well as PSU?
See, I think the reasons for underperformance has been clear. We have seen FIIs liquidating, the banking and financial stocks, and clearly the perspective is totally different. I mean, the foreign investors, they have seen, a lot of losses from their international trade, and India has been one of the markets where, they have not seen so much of cut. So this provides them a cushion in terms of, getting liquidity. And that has been one of the important reasons. Whereas if you see the fundamentals, I think today the banking fundamentals are at the best when we think about their growth, when we think about the asset quality, when we think about the profitability. And here's a scenario where the banking stocks are actually trading at lower than their average valuations if we compare it to the 5-year averages or 10-year averages. So from that perspective, clearly looking at the current business environment, what the banking business is into right now and the valuations, it makes sense to be overweight in the sector. But like you said, Sonia, there are some worries which are creeping in, and the worries actually stems from the fact that these banks are likely to become aggressive in terms of raising the deposit cost. As that goes up, that basically puts a cap on the profitability or the margins, and which is where some amount of let's say some caution arises when we are looking at the cost of capital actually going up. So in this environment, I would say that the banks which are able to, let's say, sustain the lower cost of capital or their deposit costs are lower on an average, I think those banks should do well. On the credit quality front, I think we are quite comfortable at the moment. It's environment, as I said, is uncertain. We don't know how things are going to shape up, but I think for India, it looks pretty okay as of now.
Okay. So, Vinit, hi, good morning. If it looks okay for India, and then if we are able to sort of, cut out all the noise, then how do you go about deploying fresh capital? Would you advise people to, let's say, start putting in 25% or 50%? And which sectors? I think the common sense sort of approach is look at domestic-facing companies, stay away from anything that has global exposure. What would you advise?
So I would say that I think the near term really warrants us to look at businesses which will actually survive this, it's a global crisis which we are seeing right now. And it's very simple, actually. The P&Ls are uncertain today. The profitability is uncertain, but I think, and hence it is important to look at the balance sheets and investment more by looking from the balance sheet perspective would make sense from the near term perspective. And when I say that, what I mean is that businesses which are cash rich, which are less leveraged, businesses where the certainty of cash flow is higher, those are the businesses which will prove to be rewarding maybe this year when we go through uncertain time and when the profits are going to remain uncertain. I mean, predicting profits are going to remain uncertain. So I think that is one factor. In terms of how investors should actually think about investment, you're right. I think gradually they should start looking at investing some part of the capital, maybe 20-25% to start with, given what I mentioned, that valuations have marginally come below your 10-year averages. Maybe some amount of valuation attractiveness from here can investors can look to deploy more. In terms of the segments, I would say, I mean, it doesn't change a lot from what we were thinking for a while now. I think, as I said, healthcare has already seen the pain over the last 2 years, and we believe in the the mean reversion and cyclical recovery for that sector. So that's one sector which we like. Automobile, again, as I said, has gone through a lot of pain last 2-3 years, and there could be benefit which the sector can see from the cyclical recovery over the next 2 to 3 years. Beyond that, I think IT is a sector where there again, I would say, would be an opportunity heading into the next 1 or 2 quarters as the world goes through some of this crisis. Maybe we get the IT stocks, at reasonable valuation from where we are today. So I think broadly, cash-rich balance sheets, cash flow generating companies, decent ROEs, these would be the core principles which would drive the investments and segments where we would look at investing.
Mm-hmm. All right, Vinit, good hearing your thoughts. Thank you for joining in. Appreciate you taking out the time this morning. We look forward to the next one. Okay, so we are down about 0.5% on the market. That's the way this Thursday is playing out. Let's get to our next conversation then. James Sullivan, MD and Head of Asia Pacific Equity Research at JP Morgan, is with us now.